Hi class, I'm Mike Collins. I'll be your teacher for investments this semester. Tell you a little bit about myself to start off the course, and then please use the message board to tell me a little bit about yourself as well. Interacting online for this class is actually going to be crucial. If you take a very passive approach to this online course, then you're not going to get the best results. But if you interact, you stay on time with your work, you will then get the best experience out of this course, which will then prepare you for the best outcome in your experience here at the school, and also improve your success in life. Graduated from UMass Boston with my degree in economics, my master's degree in finance from Suffolk University. I spent the last 10 years or so working on the wealth management side of finance, where I help people with financial planning, as well as ETF, mutual fund, and stock selection, and then constructing those in a manner to which will make the risk and return demand suitable for them. Been teaching since about 2008, 2009. Started teaching when I lived out in California for a job I had at State Street Bank and Trust, and then continued teaching when I moved back to Boston. I've been doing it ever since at colleges like Bunker Hill Community College, Suffolk University, and also as well Endicott College. This course is going to cover a whole range of topics that you could probably make a semester out of most chapters in this book if you really wanted to. But I'm going to do my best to make this as interactive as possible, as educational as possible, and most importantly, to keep you guys engaged, as entertaining as possible. Where it's going to be a complete online course, that's going to come with a new host of challenges, but challenges also generally will make us better. So I'm hoping that works out as well. Professionally, I really enjoy the part of my job currently where I get to interact with people, right? There's a client service function. And I also really enjoy the investment side as well, which is actually pretty unique. A lot of jobs in Wall Street are usually one or the other, where they are either very focused on client service or very focused on the numbers. I'm fortunate where I have a position where I can kind of do a little bit of both. So let me talk to you about a couple slides I prepared for you guys today. Effectively, it's the 7 deadly sins of investing. So lust, chasing performance, right? The belief investors feel that recent performance will dictate future performance. That's also known as recency bias in psychology. It's one of the biggest investor pitfalls, actually. One of the challenges with this is, this is kind of often referred to as herding behavior. In December of 2017, you probably had at least heard of, if not had someone tell you should be buying Bitcoin. No coincidence, everyone was telling you to buy it at the height of the market. As this class is being recorded in September of 2020, you're seeing very similar trends with Tesla, and even more so, well, I would say Tesla is the primary candidate. Who knows where Tesla's stock price will be a year from now? But I do see similar trend chasing patterns that I did in 2017 with Bitcoin that I see in Tesla today. Pride, being overconfident, right? Investors, especially ones new to the game, frequently believe they know far more than they actually do about a particular investment, says psychologists and financial advisors. But anyone can be overconfident. You get a few stocks right, you get a few investments correct, you make some good money. You get lucky and you buy Bitcoin at the bottom and it goes to the top, right? That success can make you overconfident. So try to be humble in this business and actually look out for answers that are counter to your thesis. So I want to know what the biggest arguments against investments I like are, right? I want to know what other people hate about the investments that I like. It's really important for me to be able to understand, and it also checks your confidence a bit as well. Overlooking costs. Investors wooed by a fund's manager's name or recent performance fail to look at the fund's expense ratio before buying in. Another common trend here would be with when you hear about someone else buying it. You go for something that has a powerful name, like you see a fund that you recognize the name from, or a hedge fund. Very common within hedge funds. Costs are often 2 and 20, meaning 2% every year, and then 20% of profits. So, while they can provide attractive returns, if they're not doing so, then they can be very costly. Wanting to join the club, envy. What is better than a great deal available to you and only you? So some people want to own certain stocks. So when they're on the golf course with their buddies, they can talk about that they own the same stocks, they have the same investments. People actually, I've seen this happen. I had someone, recently, speaking of Tesla, say they just wanted to own it, right? And it went up and they want to own it, right? I advise against it at the moment. And that's not a recommendation. That's just a commentary. Everyone's specific situation is different. So when you hear about someone buying a stock or another type of vehicle, whether it goes up or down sometimes is irrelevant, because it's really up to your personal situation if you can tolerate that level of risk. Failing to admit failure. We don't want to be honest with ourselves and admit the loss. Sometimes we'll hold on to a loser longer than we should. You can make a lot of analogies to, personal relationships, as well as investing. Sometimes you look at something and you look at the time you've sunk into something as a reason not to leave. And the same applies to investments. If something's not working out or the story has changed, let's say you invested in a biotech and that biotech had a promising drug and then the promising drug fails. Well, you have to reevaluate your entire investment thesis because effectively, everything has changed. But some people might hold it because they don't want to be wrong and realize that loss. Gluttony, living for today. Often workers aren't saving early enough because they view retirement as a far-off event. That makes us kind of, view it as far away, and something far away isn't important. We only care about things that are up close. So that's also a real challenge of investing, right? You have to be very long-sighted. Sometimes you have to buy. I might buy something for myself, for a client, where I'm like, geez, this could go up or down 50%, but in a year. But I'm not buying it for 1 year. I'm buying it for 3 years from now or 5 years from now. And sometimes having that kind of foresight can be really challenging. Netflix, hit 100 and went down to 20 before going up to 500. How many people out there could tolerate those kind of losses? Greed, following the herd, similar to another slide we just saw earlier. You might also hear following the herd. You might hear Warren Buffett bought something. Well, should you buy it? Well, maybe not. But the challenge with that is that Warren Buffett's risk tolerance and time horizon are completely different than yours. Warren Buffett can afford to buy something and not look at it for 10 years to the investment thesis to play out. While you might not have that luxury. Or even if you do have that luxury, do you have the discipline to stop yourself from making the wrong move at the wrong time? When we're in the middle of a crisis, are you the one selling into the crisis or are you the one buying into the crisis? Generally speaking, buying into the crisis is more profitable. Even though we know this, many people want to sell into these crises. So, just another important consideration. So I hope this was a good set of starter slides and discussion. Please participate in the message boards. Details will also be in the syllabus. And I look forward to working with you guys. Do not hesitate to reach out to me and let me know if you have any questions.